Thank you for the invitation to talk to you today. Particularly pleased to be able to come and speak at the crop updates. I've entitled my talk today, "The Agronomist's Folly, Yields Ain't Profits," and I think the consequences of the last 2 years of crop growing in Western Australia is the reason for the title. I'd like to acknowledge my previous associates at Farmanco Management Consultants because they've provided me with a lot of the data I'm going to talk about today. The consequences of the season, as outlined by David Bowen, no doubt will reflect in the financial performance of many farm businesses. For people in the eastern, central and southern Wheatbelt, it's been the second year in a row where there have been substantial losses accumulated, and in many cases they will now exceed $1 million. A lot of people have focused on 2010, but I'll show during my discussion with you that 2009 was equally a very, very poor year for a lot of people in the Wheatbelt. Normally, if you expended $1 million, it would probably be on buying more farmland, and hence there would be some increase in production capacity or profitability. This is not the case from the results of 2010. So these businesses now have got an accumulated hardcore debt, which they've now got to pay back some way. There are exceptions, as shown by the data that David put out. We had some fairly good seasons in the northern Wheatbelt, and last year in a lot of cases was at least break even. On the south coast, the Esperance area has actually had a reasonably good run of seasons, which makes them slightly different in the general sort of circumstances we're talking about. When we measure the financial stability of a business, we use equity, in other words, the assets less the debts, to establish where we believe the business is, and we therefore establish an equity ratio. In most circumstances, the equity ratio of 70% is the crossover line between the business being financially stable and potentially unstable. The rule of thumb that I've used for many years is a percentage of equity of about 70% is the minimal acceptable. This set of data that Farmanco have provided me with shows where we started in 2010, remembering that we'd already had a bad year in 2009 for many people. And clearly you can see, if I use my pointer, that the majority of people were above the 70% line, so fairly safe and fairly stable as farm businesses. If you watch that and project it forward to where we are today, suddenly there's been a large movement of businesses below the 70% equity base. This group has now grown to be a critical part of the farming businesses that are out there at the moment. This is a sample of probably 300 farm businesses, but I would say that from Geraldton to Esperance. So the data is masked by the fact that there are some poor and good results. Equally, we measure the debt against income, and we say if the debt is large, how does it relate to the income of the business? If the income and debt are equal, in other words, if we have a ratio of 1 to 1, this is the crossover line generally between the business becoming unstable. If the debt is at 1.5 in relation to income, you can see that instability or inability to service the debt is going to follow. In a lot of instances, businesses last year faced a debt to income ratio of 2, so the debt was twice as large as their income. So it ain't going to be pretty for many people, and it does mean that you need to look completely differently at how you apply agronomy packages and agronomy outcomes to the production of 2011 and beyond. It may have taken 1 or 2 years to get into this situation, but I've got a feeling unless there's a massive turnaround in profitability, it will take probably 5 years for a lot of people to recover the position where they were. What happens, of course, is that it raises a few issues of choice. As you can see by my chart here, there are a number of businesses out there that have got good equities and low debt to income. These are the people who have the potential to expand their businesses if they want to. There is also a solid mass of people who are in what I call the consolidate mode, which need to improve their equity by continuing doing what they're doing. The sad part is that there are a number of businesses now that are in the survival, non-viable or exit phase, and this is going to have to unravel itself over the next period of time. If the businesses are less than 50%, they're probably not going to be able to survive in the current environment. The people with an equity of 60% are going to struggle to regain that position. It'll depend very much on grain price and interest rates. As far as the people with an equity of 65%, it could be a very long haul, probably 5 years or more, as to whether they will be able to make a viable improvement in their business. So it's all very serious stuff, and you've got to be aware of these people that you're dealing with. Compounding this is a trend that's been appearing over the last decade. Previously, when the price of wheat went up, the price of land followed. Consequently, when the price of wheat went down, land tracked down. This was a consistent trend through the 70s, 80s and into the 90s. At the end of the 90s, we had a movement of disconnection between land price and wheat price. The wheat price went up, the land price went up. If the wheat price went down, the land price continued going up. This we thought was an anomaly, but in the 2000s it became an exponential trend with no rationale about it. So we've seen land values escalating for over a decade, despite what profitability of the farming business or the grain price was. What you're now starting to see is a tip over. Previously, when we've had a tip over, and it's happened 3 or 4 times over the last 30 years, land values declined by 30%. If you consider this in light of the equity of a number of these businesses, a number of businesses are going to be very, very critically hurt by an adjustment in land value. So I think you need to bear that in mind. I've had some people say to me, what's caused this land value increase? Is it overseas buyers? No, it's not. It is basically that 95% or more of the farmland that is bought in Western Australia is bought by farmers. So it's a self-inflicted wound in some ways, which is going to have some probably difficult consequences. Having said that, what are some of the consequences? The stresses certainly associated with these circumstances within this period of time will be seen in a number of ways. We'll firstly see conservatism, lack of focus, indecision, and the inability to see opportunity. The consequences of this are that things that should happen may not happen, and these may have some additional consequences for the business. If it is a higher risk environment which we are operating, and when we say we, I'm talking about agronomists, what are the areas that have a direct impact relating to the agronomy advice that you are giving? Quite clearly, if people are under financial stress and they exhibit some of these particular attributes, they're not going to be making good decisions on your advice, and that puts a lot more importance on the advice you give and to see that it's applied correctly. The other thing that's very important is that there are a number of key areas of risk to the business. I've listed these as production risk, financial risk, management, in other words, key people, markets, and family succession. From your point of view, as an agronomist, I'm suggesting that production and management are the 2 real areas of focus for yourselves, where you could have a substantial improvement or substantial risk increase depending on the advice you give. I notice that many agronomy reports provide enterprise margins for a particular crop in question. This is based on a price per tonne by yield function, 2 of the key things in generating income, and the associated input costs. What it fails to take into consideration is the associated fixed costs of running the business. These are usually somewhere around $50 to $70 a hectare. Plus, it doesn't make you aware of the fact of the repayment of debt, the replacement of machinery, the payment of tax and the payment of drawings. These are all going to be very critical where you're seeing low equity businesses which are short of cash. So the key issue to consider is that advice which is increasing the cost of production does need to have some consideration on how that is going to be paid for, and equally what sort of return is it going to give to the grower in this instance. If he is already under extreme financial pressure and has limits to the amount of working capital that he has, it's important that you give lower risk but an effective strategy in place of rather higher risk go for broke strategies. You've got to be very cautious about pursuing high cost, high input type cropping regimes with the expectation of them being more profitable. I don't think that's the opportunity that we have at the moment. These are a series of profit analysis from various enterprises, which I think it's important to reflect on. You'll notice that the wheat has always been the key driver of the of profit in the farming system here in Western Australia. But even that in the last 5 years has had 2 loss years. When we put the 2010 data onto this, it'll be 3 loss years in 5, and that's why we're seeing this impact on the farm business. Barley, of course, has come to its fore as also another profit driver, but equally a new crop in canola has been a major profit contributor. The important issue is not to lose perspective in designing your rotation as to what some of these crops can and can't do. 2 of the loss makers are lupins and field peas, the pulse crops. This loss has got to be carried by the business, and therefore that's going to restrict in many ways the strategy of how you're going to generate rotations which are completely sustainable. The other area is the one of oats, which traditionally has ended up in hay. This can be either very profitable or not. We've also had, Eric Neckerville did these data for me, and he included sheep as the last issue. You'll notice here that the panacea for sheep sounds wonderful at the moment. I read in the press that wool prices have doubled, and you certainly know what sheep prices are doing. Even given that scenario, we're only expecting about a $30 profit from sheep in this coming season. So it's not a panacea which you can say is going to save everyone from everything. It needs to be born in reality to where we are. So often we see agronomy decisions are made which actually are too high risk and based on the probability of perfect outcomes, which often don't eventuate. Second, we often see agronomy decisions which are totally cosmetic in application, but in being cosmetic, they actually decrease the profitability of the cropping enterprise. Those sort of luxuries can't be afforded for many people in the current situation. So it's very important that the agronomist is aware not only how to generate a yield from a crop, but also to know what impact it is going to have on the profitability of the crop on the decisions that he makes. This is a trend line of the costs for both the medium and high rainfall area. You notice that they trended up through 7, 8 and 9, peaking in 2009, which was a substantial loss year for many people, dropping back in 2010, and our projection for this year is about $300. So from the point of view of 286, the price of the crop inputs is going up. I think the crop inputs are on an upward trend, which has got serious consequences not only for this year, although most inputs have been bought, but certainly for 12 and 13, which are likewise consolidation years for farm businesses that are under extreme debt conditions. The important message, though, is that fertiliser makes up $100 of this $300, or 33%, herbicides $60 or 20%, so the agronomy risk is 53%, or more than half of the input costs in growing a crop. It's a pretty big responsibility for the agronomist to be aware of the amount of input he can have into success or failure, because he is controlling some pretty big levers. I think cash is going to be limited, and therefore decisions need to be very cost efficient. Yield for the sake of yield without a good understanding of profit is certainly going to lead to an agronomic folly. So what have I said in our discussion today? Business equity has decreased in many cases to critical levels. From your point of view, you must be aware where the equity of the business is. If it's below 70%, a business at risk. If it's below 60%, it's more than likely a non-viable business which is under extreme financial pressure. Know your client's risk profile. If the business is under financial pressure, no doubt the family and the manager will be under pressure, and he may be displaying some of these indecisions and conservatisms which will make it difficult for him to convert the advice that you think you're giving into actions, and that's going to be important for you to appreciate. Lack of focus and poor decision making could be your biggest issue. A flexible but balanced rotation is important to profitability. It's not time to start experimenting with radical rotations which may be loss-making or risk-taking. We've got to take a very clear focus that we've got to generate more profit to get out of this particular situation. High cost, high input systems are also high risk. There's been a number of experiments done in Western Australia on high input regimes, and generally they do show there is not much benefit or any benefit in a lot of situations. The agronomy risk is 53% of the crop input costs. The responsibility of the agronomist for that amount of input, which is substantial, is a fairly serious and responsible thing to manage, particularly where cash is limited and costs need to be very efficient. I'd just like to conclude by saying once again that yield without an understanding of profit can be an agronomic folly. I hope that you don't have a folly of that magnitude. Thank you.
Thanks, Ken.
Ken, I thought you covered that very well. The thing that concerns me, and has been for some time, is, as you said, traditionally our land price has been driven by farmers buying neighbours, etc., etc. Looking at those first couple of charts, you got, I don't know, 20 to 30% of people in a difficult situation, and you've got some that are in a consolidation and growth phase. But one of the problems is we've also seen farmers getting bigger and bigger and bigger, so it becomes very much harder to buy a chunk of the neighbour's farm. So for the people that do want an exit strategy, who's going to help them?
It's a good question, and I think holding out the panacea that it's going to be government or overseas investors is, I think, another folly in many ways. This is not just a problem that's appearing in Western Australia, it's a serious problem in New South Wales as well. My understanding over there that you might be horrified by these figures, but in a lot of cases over there people have got no equity or very limited equity. So it is in the two key cropping bowls of Australia, it is an issue. There's going to have to be an adjustment period. Most people would hope that land prices won't fall, but that pressure will be determined a little bit by the banks, because they are the money lenders in this situation. It will also be determined by who is going to buy this land, because my understanding is a lot of farmers who have traditionally bought land to expand their operation are equally, even though their equities are quite high, are quite nervous about looking at expanding in the current situation. You can understand that to some degree, and the reason for that is that the value of land against productivity is still out of kilter, so there does need to be an adjustment period. So my observation would be, having been through this before, that we are in for a pretty tough time. There will be investment come into agriculture, I'm not denying that, and so they will soften the blow in some ways of people wishing to exit out of the industry, but it's not a panacea for a total answer. A lot of the guys that I've dealt with in the past, I've spoken to recently, and one of their concerns, these are viable farmers, good equities, is they've been really quite shaken by the seeing that you could lose $1 million in 2 years, and that is a fair bit of capital they've put at risk, and that's concerning them as well. It may lead to a number of different innovations that come in where we see people wanting to participate in agriculture but in different ways, not only in land ownership, and that may be some of the change that we'll see with this innovation that we're talking about.
Ken, I'm going to make a bit of an assumption here that I'd like you to comment on. The crop, by crop type that you had up there, and the obviously the negatives that the lupin, peas, hay throw in the equation. Your consulting group and others would probably have enough data now over the last decade with a much lower percentage of those crops in the system. How, when you've removed them and you drill down into your data set more, how has them out of the equation impacted on the wheat and barley yields and therefore the overall profitability as well over time?
Just on the season or the...
Oh, over the years. So I mean, if we take all the lupins and the peas and the hay out, we're going to assume that wheat and barley yields are going to decrease.
Yes.
And frost and weeds, etc.
So your question's around the rotation impact.
Rotation impact.
Yeah, look, this is, it's a very good question. What actually happens in rotations? In a perfect world, if you're making a lot of money, you would have a lot more pulses and other crops in your rotation. As people get pushed, they tend to push their rotations, and what you've seen over a period of time is a lot more double wheat, a lot more double barley, and that's for various reasons. One of them is a risk-related reason. We've seen some new crops come in the decade. We've seen canola come in as a new crop. In many cases, it can be profitable. It's not a crop that you couldn't just put half the farm into canola with the expectation that that would be a good panacea for getting you out of this situation. The concern that always has been to me is that the pulse crops have not been profitable. They can be profitable in certain areas. In the northern Wheatbelt, lupins at 2 tonne, of course, are very profitable. But in other areas, that hasn't been the case. And peas, of course, have suffered. Even though they've performed well, they've been very frost prone, and that's the consequences of the seasons have made it very difficult for incorporating them in the rotation. So what I've seen over a period of time, it's been a closing up of the rotation with less pulses and more cereals coming in. The consequences of that, I think, will mean that we're driving more of a monoculture which is driven by inputs, which then puts more responsibility back on the hands of the farm manager and his agronomist to perform. So it is a high-risk strategy, but in a lot of cases that may be the only strategy that's viable for people in the short term, and that's something you've got to consider.